Well, Morgan Stanley is tapping the brakes a bit today, warning that the risk on trade might be cooling off. The firm has changed its outlook on sovereign debt based on what's happened in places like Ireland, Portugal, and Spain. Let's bring in Greg Peters, Morgan's global head of fixed income research. Greg, tell me, what is it on the Chinese inflation front and these new concerns bubbling up in Europe that are making you question the risk trade a bit?
Well, it's just, I mean, week over week, we have seen a sizable move in what's happening in the sovereign space. You just can't ignore that. You can't ignore the inflation numbers coming out of China last night. And so, look, I'm still very much in the camp that QE2 is going to be supportive for risk assets. But I think it's important to note that there are stresses that are starting to show, and I just don't want to ignore them. So it's really quite simple as far as that goes.
Well, one of the upsides of QE2 that supporters would say is it was going to help out equities, and the risk on trade means the expectation, right, that equities are going to continue to go up. You're seeing a cap on that?
Yeah, I mean, I still think that's the clearest way to trade QE2 is through equities. But at the same time, I don't want to be blinded by QE2 either, as that's precisely the same problem that happened at the beginning of this year, if you recall. The equity market just ignored all the signs, the negative signals out of Europe, and it was to the detriment ultimately. So my point is that there has been a sizable change in Europe. It's a problem. It's a long-standing problem. I think we already know that. But it has flared up in a meaningful way over the past week. And so I just want to highlight that. And there's other issues, too. I mean, Cisco, what I think is a very important event. Obviously, the China market sold off quite hard last night. So I don't want to be just completely insulated by what's happening around me.
So you, though, aren't saying that you're expecting a default or something that drastic in Ireland or in the rest of Europe, but you do see risk even short of coming up short on payments.
Well, it depends how you define default. I mean, at some point we do think they have to tap the facility. Does that actually solve the problem? No, you have to tackle the bank issue. So once again, this is a long, hard process, but ultimately it's about Portugal, it's about ultimately Spain. Spain is the linchpin in here, and so that's what we're really focused on. So I think the market already is pricing in a restructuring of Ireland and even Portugal to a certain degree. So Spain is really what we're watching most closely.
Yeah. When it comes to what's happening here at home, in reading your research here, you said a bubble seems like hyperbole, but kind of looks a little bit like that in the Treasury market.
Yeah, so I mean, the big debate in fixed income land is what happens to rates and Treasuries and fixed income broadly speaking. There's a rating debate whether it's a bubble or not. I don't think definitionally it's a bubble. My standpoint, though, is I don't care. But I think you're actually set up for failure either way. You're looking at all-time low yields in a variety of different fixed income asset classes. And so the asymmetry of return is highly skewed against you. So it's just a matter of when that these yields are going to move higher.
So translate that into a trade here, because I'm looking at your calls and they still sound like a risk trade is on. You're selling the dollar, you're going long equities. What has changed, particularly in the fixed income front for you?
I would say it's much more muted. So yeah, we haven't changed our trades per se, but we were expecting much more negative dollar moves. That's probably less likely now. We were expecting much more positive move in the belly of the Treasury curve. That probably is less likely now. So it's just tempering our enthusiasm around those trades. So we're still in risk-on mode, but they're much more cautious. So what we're telling clients is if we were on a scale of 1 to 10 of bullishness around those trades 2 weeks ago, we've cut them pretty significantly to about a 5 or 6.
All right, and that means for you buying the belly of the curve, as you call it, the 5 to 7 years on the Treasury front, buying high yields, buying commodities and commodity producers. Thank you so much, Greg, for joining us today.